The euro slid the most in 14 months against the dollar after a proposed levy on bank deposits in Cyprus threatened to worsen the European debt crisis. The 17-nation currency fell to a 2-week low versus the yen as the nation postponed a vote on meeting demands by regional finance ministers to raise €5.8 billion $7.5 billion by imposing losses on its depositors. The euro pared its drop as declines in Italian and Spanish government bonds were limited. The New Zealand dollar and Mexican peso weakened as investors sold higher-yielding currencies. The biggest fear right now is that there could be a domino effect, which is pushing the euro down, Douglas Bortwick, the managing director and head of foreign exchange at Chapdelaine & Company in New York, said in a telephone interview. What the market doesn't understand is that people who take out money may still put it elsewhere in the eurozone, so I would argue that it's not euro negative. The euro slid 1.1% to $1.2928 at 9:35 a.m. in New York, after dropping as much as 1.5%, the biggest decline since January 13, 2012. The common currency slumped 1.5% to 122.67 yen after falling to 121.15, the weakest level since March 5. The yen gained 0.4% to 94.90 per dollar. Trading fluctuations one week implied volatility on the euro-dollar exchange rate rose 34%, the biggest single-day increase since May 2010. The gauge climbed to 11.23% before trading at 10.22%. The premium for one-month options granting the right to sell the euro against the dollar relative to those allowing for purchases increased to 1.18 percentage points from 0.96 on March 15. The 25 delta risk reversal shows. Scenes of Cypriots lighting up at cash machines raised the specter of capital flight elsewhere and threatened to disrupt the market calm that settled over the currency bloc since the European Central Bank's pledge in September to backstop troubled nations' debt. The terms of Cyprus's bailout are negative for depositors across Europe, and may hurt bank ratings region-wide, Moody's Investors Service said in a credit outlook report today. There's concerns about the dangerous precedent that this sets in terms of other so-called depositor guarantees, said Annette Beecher, head of Asia-Pacific Research at TD Securities Incorporated in Singapore. It's the de facto breakup of the euro in the fact that having money in a Cyprus bank isn't worth as much as having money in any other bank. Dip buying the euro trimmed declines as the impact of developments in Cyprus had relatively limited impact on short-maturity Italian and Spanish bonds, said Arne Rasmussen, head of currency research at Danske Bank A/S in Copenhagen. There's buying on dips after the euro's significant move and some people are taking a wait-and-see stance ahead of the parliamentary vote, Rasmussen said. Cyprus is a major concern in our view, but I think the near-term recovery of the euro was driven by the fact that losses in Italian and Spanish debt were fairly small. Italy's 10-year bond yield increased 4 basis points to 4.64% after rising as much as 21 basis points. Spain's 10-year securities climbed 6 basis points to 4.98%. Cross borders. The issue is whether to believe that the Cyprus levy on depositors is one-off, but depositors and investors elsewhere could easily see this as another in a string of one-offs and react badly. Stephen Englander, head of Group of 10 Currency Strategy at Citigroup Incorporated in New York, wrote in a note to clients. The euro will be sold against a range of currencies including the dollar, Swiss franc and pound, he wrote. The 17-nation euro tumbled 1.1% to 85.59 pence and dropped 0.4% to 1.2221 francs. The euro has weakened 1.4% during the past month, the second worst performer after Norway's krona of 10 developed nation currencies tracked by Bloomberg correlation-weighted indexes. It has still strengthened 2.2% in the previous 6 months. The New Zealand currency fell 0.3% to 82.46 cents. The Mexican peso dropped 0.4% to 12.4892 per dollar and the Australian dollar declined 0.1% to $1.0395. The concern in Cyprus moves risk-on trade to backseat, Bill Gross, who runs the world's biggest bond fund at Pacific Investment Management Company in Newport Beach, California, wrote on Twitter. Sell euro as well, he said. The Hungarian forint fell to a 14-month low against the euro as concern Europe's debt crisis will escalate added to the turmoil caused by the government's plan to cut borrowing costs. The forint slid 1.9% last week as Prime Minister Viktor Orban called for lower interest rates and for measures to help foreign currency borrowers. The currency dropped 0.6% to 307.09 per euro after sliding to the weakest level since January 18, 2012.